All right, everyone, welcome back for another episode of Carnivore Trades. Today is Saturday, July 20th, 2024. If you're not done so already, please give the video a thumbs up. Like, comment, subscribe to the channel. Come find me on carnivoretrades.com for swing trading alerts, analysis, and live day trading. And I was doing a little special video today, extra video for you guys. And this is a topic I thought about doing a video on for a little while, because I think it would be appreciated here by the channel. So anyway, what's going on here? What is the video? So why did I really turn so bullish this year? Because obviously, I'm a trader, and I don't really care where the market goes as long as I'm on the right side of the trade. It's not really that important to me. But you guys know I like to trade ranges, and even in a bull market, I'll fade the market if the chart tells me to, or if we go into resistance, right? I don't mind. We go into support in a bear market. I will buy. I mean, there was plenty of times in 2022 where we're going long and into support, and it's that to me is the best market. Like, that's heaven for me. Like, 2022 is actually heaven for me as a trader, because I like ranges, I like volatility. But what really kind of, you guys know lately, if you've been following the channel, I've been like really adamant, like almost, obnoxious. And I'm aware of how I am at times. But, I'm doing that for a reason, but almost obnoxiously like dismissive of the breadth, which is something that a lot of people have lamented. I've been very, just adamant about just buy the dip. I've also given out specific dates of when to buy the dip, specific assets and asset classes to get into, as we've seen rotation out of chips lately. And I'm just going to kind of go over, why that is really. So hopefully that this video can help explain things, and hopefully you get anything, get some good out of it. If you do, again, give the video a like, and let's get to 4,000 subscribers. So anyway, let's get into it. So markets here, obviously had a big melt up. We had to go back to, so if we go back to October, we put in this low, obviously, and then we just had this melt up here. Now at the beginning of the year video that I did, or in January, I said, I don't really, I'm not really bearish on the market here. Doesn't mean we can't have a volatility event. Doesn't mean we can't have pullbacks. But overall, I had kind of like a bull thesis for the market for the year. I did lay out the giga bull thesis, which has obviously played out. I, went on record saying I didn't think that was going to happen. But obviously it has. But one of the things here, I would say there's a couple of things I'm going to go over that can certainly explain, why you should turn bullish, period. But, it really boils down to, for the most part, it really kind of boils down to this April correction and what I saw there. Not so much just in it, but like leading out of it. So we all know, at least I think everybody should know by now, they're goosing the tape, right? I mean, Yellen, had the QRA, and I think that, she leaked it because that was, scheduled to come out earlier, or, this week here. And the market magically gapped up over the weekend. And, usually when a market bottoms, it's not going to gap up. It's going to gap down to get max fear. And that's how you get the V shape. But we got a gap up. So that tells me somebody got, that information got leaked over the weekend. But, she's been issuing out at the short end, and that's been helping up markets. Now, as, what's the word, like, as irresponsible, as, not doing her job, as that is, is offensible as that is, that's the reality, right? And I learned a long time ago, you don't want to fight these people when they do something, because they have infinite money. And in any case, and then we had Powell, who went full 180 dove right here after 2 weeks after he said that we're holding the line higher for longer and that type of thing. He flipped on the FOMC. So you got the Fed and the Treasury in cahoots to goose the tape. But really, that doesn't mean you can't pull back, right? Generally speaking, right? We'll get to some of these other things here, but I want to skip ahead to this April correction. So a lot of this happened here. We did have a pretty good high volume reversal. And if we look at the spiders, you can see it there. Higher than normal volume. We had 2 distribution days not that long before there. And if we look at the Qs, we went flat for like a month. And 72 million, 52 million, or excuse me, yeah, 52 million and 72 million shares. Heavy volume, heavy sell volume on the Qs in that same time period. Then we had another, the confirmation there. So that was likely, telling us, okay, we're going to get a bear pattern. We're going to go down. And we did. We had some deleveraging. Iran was kind of, I think it was just kind of a convenient that Iran, did that whole thing with Israel right around this time, because it was like a market that was already kind of deleveraging, and then you have that get thrown. I said immediately, I was like, Iran doesn't matter. Like they've been doing this stuff. Iran and Israel have been fighting forever. We've been seeing these headlines for 6 months. The market never cared. So it's just a matter of timing and whatnot. But we came down. We had a low. I said, buy the dip. We bought the dip. I said, keep buying the dip. We kept doing that. Then I said, I kind of went bearish here. And the reason I went bearish is if you look at the weekly chart, there's a lot going on. So, we could let's put our trend lines back up. Don't worry about all this extra stuff, but just worry about the previous all-time high, right? Right around 4,800. You're coming into April OPEX, then you're coming into May. A lot of open interest there at 4,800. Previous all-time high. That would also make us flat for the year. And if we take a fib from the October low to that high, you're going to see, there's a 382 right there. So a lot of convergence is going on. And this was a 20 to 25% move from here to here. So, a pullback to this area is not that big a deal, right? We only had, I think, like a 8 or 9% pullback here. So it's not really that big of a correction, considering this was still a historic move. And obviously it's become even more so now, as the Qs are up almost 40%, almost 50% since the October low. But the reason I got bearish is because you had this big outside candle on the weekly, specifically on tech. What was leading the market at the time? Tech, right? If we look here, and even if you go to NQ, you're going to see we actually went negative for the year at one point in the overnight. And in the triple Qs here, we basically went flat for the year. Now, what you did here with this outside candle, this is unusual. Big uptick in volume, and you had distribution for weeks. You went sideways for 3, 6, 7 weeks before this. In this one candle, though, we wiped out the entire quarter's worth of trading, more than a quarter worth of trading with volume. As a technician, and as somebody who's been doing this for a long time, the reason I went bear here, and I only went bear, I said I made this very clear. I'm bear to this, right? I'm bear to SPX 48, maybe like 47.50, and he always overshoots, maybe even undershoot, 48.50, right? Or 49. But it's really unusual, right? It's really unusual to get a move like that wipes out an entire quarter, more than a quarter's worth of trading in 1 week, and then to not have any continuation, right? So it's just very unusual, right? That right there, the fact that we recovered so easily was a humongous red flag. So I was expecting a low pivot when, if you guys have been following the channel, by the end of May, right? I traded this low pivot, and we did very well on that. And at the time, though, in April, early May, it was kind of expected that we were going to do this, and then, okay, there's your low pivot lining up perfectly in time. And now you can go, higher. The fact that we recovered that easily was a huge red flag. So that's one of the things. Another thing is it's a little bit more subtle here. It's kind of a technique, though, and I think this is something I think a lot of people get wrong. But when it comes to gaps here, so let me clean up the lines again. And let's look at the gaps here. Well, let's look at the fibs. So my thesis here was buy the hell out of the dip here. Blah, blah, blah. Okay, you're going to go up to the 618, right? Maybe the 75 or 786. And then that should be a good selling opportunity. You should roll over there. There is a gap right here on SPX at 51.99. If you look at SPY, if you guys use that, it's right there at 518. A lot of people got bearish because we filled that gap. In the time I've been doing this, I've learned that, so there's a lot of people who think that filling the gap is bearish. It's not. You don't want to fill the gap. It's a sign of strength, honestly. The bears, if they're strong, they should defend before you get to that gap. And we did not do that. As soon as we filled that gap, you can go back and watch the video. I was like, you could tell how I was like kind of hesitant in that. And then from there, we just didn't even pull back. And that's when I just abandoned any hedges I had. And we were just looking for dips to buy. If you go back, I'm not saying it works every time, but it works almost every time. I mean, go back to here in 2022, so we had a bear, so it's a pretty good, indicator, or a, it's a good market to use. There's a lot of volatility, but these gaps here, these breakaway gaps, like right here, not filling that is important. Right here, the gap down, coming back up, not filling these are important. If we go even to here in September, we came back up, we pierced the window, we never got to the gap. I know it seems like it's not a big deal, but it's, I've seen it time and time again. When those gaps get filled, it's a sign of strength. Now, if we go back to right here, in early Feb, right, we came down, breakaway. What happens as soon as we fill this gap here? It starts consolidating, right? It starts getting ready to go higher. It's those gaps when they fill, it's, it could be a short-term signal to short, or likewise bull, could be a support level. Again, psychologically, gaps do work as support and resistance, because that's the last place before an impulsive move. But usually when they fill, I've noticed that it's not something you want to stick in for a while. Again, right back here, we rallied up to where, basically the 75% fib, 786. Did we fill the gap? No. Down move. Did we fill this gap right here? Nope. Right. So as soon as we start going up, those gaps get filled immediately. Right here, breakaway gap. This gap gets filled immediately. We consolidate and go higher. It was a big red flag. Big red flag when that got filled. And that told me to get the hell out of those hedges. And so going back to the beginning, we know Janet Yellen's goosing the tape, right? We know reverse repo is being dumped into the market, right? That was a huge red flag. That recovery, the gap fill, and how quickly we recovered just essentially told me like how adamant they were about propping this thing up. So another thing too is corrections through time versus price. So going all the way back to this bull run, the very beginning, we have not had, outside of April, a correction through price. Every single one of them has been through time, right? I even tried fading these two. I stopped out of both of them. Right here, one down day, and it's a sideways trend. It's not a pullback here. I was looking for a pullback. I was right about this. I was right about it stalling out right here, but it didn't go down. It just went sideways. Then up, sideways. Right. I was short here. We got a red day, and we went up the next day. And I immediately said, "We're running out of time." Right. We're running out of time. You guys heard me say that multiple times. The bears, they're running out of time. Right. Right here. I said they have to do damage to this chart soon, right? It's not all corrections have to be through price, but all of them have to be through time. And there's these little cycles and rhythmic patterns that the market goes through. And if you don't damage the chart in a certain amount of time, bulls pick up and they resume. And the same thing with, same thing on the other side with bears too, right? I said, look, bears, you got to get below the 20. You got to break. You got to get through this gap. You got to do this. And they didn't do any of that. So there were plays that, you could have taken advantage of these. I mean, they're not dips. I mean, this one kind of was, but they're consolidation. You don't have to get a dip or a correction to buy. But overall, really what it comes down to is, again, yeah, they're really goosing the tape here. I think a lot of the reason that this market has kept going up is I think there's a lot more people betting against it than people really realize. Only recently did we get to a dangerous level of bull positioning, and that was just this past week. So please don't take this as something predictions for moving forward. This is just kind of reviewing a couple of things that I looked at earlier this year, and why I'm sure a lot of people were surprised at how bullish I turned, but I was kind of looking for dip buys here in the summer anyway, and just a couple of reasons there. Correcting through time versus price, it's never bearish. Gap filling, and I mean, honestly, this was the big one though, is that when you can just negate a sell bar like that, of that size and that magnitude, like it's nothing, that's something you want to respect. Don't fight it. Trust me, I'm saying this for a reason, because I have fought them before. I'm like, no, I have to be right. I'm right. The market's wrong. No, you're not wrong. Your profit and loss is the only thing that's right. You can talk about people say, oh, the market's manipulated and stuff and that. I'm not going to argue it's not, but does that make the money not spend any of the same? Do you want to win or do you want to be right? So a couple of things there. Hopefully that helps. Additionally, there was a lot going on here with other sectors. There was some rotation. I did see that in advance. I talked about the rotation out of chips into possibly cloud software. Again, kudos to Chatterflow for this chart here. This was back in June 3rd. Software stocks underpositioned heavily versus chips. That was a sector I got interested in. I got into that with members. There's June 3rd, by the way, right there. So right near the lows. And we were in this with members. I even talked about it on the channel. It's a freebie. You also had this kind of head and shoulder pattern here that I predicted would fail, because I just too many people were going to see it. And it did. It failed pretty much immediately. That was a really good bid. Another thing that I was involved in was the IWM, and that was the trade of the year. I was in that with the RTY futures, which really was a monster. We were also in it with UWM, which is 2x long the Russell. So 2 services, 1 day trading and 1 swing trading, and we were in both of those. But again, I figure, well, if you've got a rally in, a very slim leadership here, and the Russell is lagging, the rally is not going to end until the breadth kind of maxes out. Because that's the last leg the bears have to stand on, right? If all I can talk about is breadth, this, breadth, that, and they keep betting against the market, the pain's just going to continue until their last argument gets crushed, right? And how do you crush that? Well, you just, you crush it, right? You break it out. And I'm not the only one that thought that. This is actually making the rounds now as well. And I'm sure everybody knows now, but Stan Druckenmiller was in IWM in March. So I think it was 15% of his portfolio in calls, not stock, right? So this is something that could go to 0, and he was comfortable putting 15% in. So he saw this too. Now it's getting thrown all over the internet. So it's probably topped out, but couple of reasons there, a couple of things that kept me bullish, and those are 2 of the bigger winners that I kind of predicted here. Another one too is the transports too. A lot of people are betting on recession. I didn't play the transports, but I figured they would get a bounce. A lot of people betting on recession, and if you just look at the charts, is this an ascending triangle? Yeah, it is. It's bullish. So again, the charts really guide you. That's the big thing here. Forget the narratives. Look at VNQ, commercial real estate, junk, right? Absolute junk. But it's a bull pattern. KRE, junk, hated, a bull pattern. I talk about KBE every single day in the videos. Monthly, bullish in sidebar, it's breaking out. So again, use the charts. Don't fight them. That's really the bottom line here. That should be what the video is about here, is don't fight the charts. Trust them. And trust them to be right because your narratives are probably going to be wrong more often than not. I mean, my narrative, I have my own opinions and macro stuff, and I do like talking macro, but at the end of the day, I gotta go with what the chart says. And again, it's much better to just stop out, take whatever 3% loss or whatever it is, and then just, you don't have to flip long. You could just trade something else. You could put your capital to better effect or better use. But again, when you see that, you see this outside move just negated like it's nothing, that's a really good sign. You want to get the hell out of the way, because when bull markets run, they go and they don't stop. And again, I've learned that the hard way, just why I'm doing this video here. So anyways, guys, hopefully it helped out you guys here. If you guys like the video, don't forget to like, comment, subscribe to the channel. You guys take care. Come find me at carnivoretrades.com, and I'll see you guys all next week.